The news cycle is moving so incredibly fast right now. I mean, just keeping track of the data points feels like a full-time job. But what happens when the news isn't just about, adoption or price, but about these fundamental structural shifts happening at the highest levels of global finance and even statecraft? That's really the mission for this deep dive. We feel like we're moving past that old adoption phase and into this high-stakes world of integration. The latest intelligence briefing we've been reviewing actually characterizes this transition. It says we're moving out of defensive consolidation and into a phase they call, and I'm quoting here, sovereign dislocation. Yeah. That doesn't just sound like market noise. That implies a violent state-level repricing of these assets.
It does. And what's defining this moment is this unprecedented collision of three massive forces. First, you have this completely unexpected and, frankly, dramatic geopolitical supply shock. It's being driven by a rogue sovereign nation's hidden reserves. Second, we're seeing a really decisive, proactive regulatory pivot from a major G7 economy. And third, that final operational bottleneck, the thing that was preventing major corporate adoption, is being aggressively dismantled as we speak. These three forces, when you take them all together, they have fundamentally repriced Bitcoin overnight as a geopolitical asset.
Okay, let's unpack this, starting with the headline that really sent shockwaves through the market, the $60 billion freeze. The capture of Venezuelan President Nicolás Maduro by U.S. forces is, obviously a major geopolitical event. But the market implication, that's even bigger. It immediately led to intelligence about a massive clandestine shadow reserve that the regime had been building for years.
The scale is just immense, and you have to understand it as a forced supply contraction. The reports we're seeing estimate the Venezuelan regime's holdings are between 600,000 and 660,000 BTC.
Wow. And at the current price point, what does that translate to in dollar terms?
Well, at around $93,000 per coin, that reserve is valued roughly between $56 and, $67 billion.
$67 billion. To put that into perspective for you, if the regime still had control of those keys, it would be the fourth largest Bitcoin holder in the world.
That's right.
That rivals the estimated holdings of Satoshi Nakamoto. It surpasses the combined treasuries of giants like MicroStrategy and BlackRock.
Yeah.
This wasn't some side project for them.
No, this was their strategic, sanction-proof treasury. And if we look back at how they built it, it's a fascinating look at geopolitics and monetary strategy. This wasn't built for speculation. It was all about sanctions evasion and, frankly, survival.
So how did they do it?
The accumulation happened through two really distinct channels. The first and the largest was what we're calling the gold swaps between 2018 and 2020.
Gold swaps.
Yeah. Venezuela was exporting physical gold to its allies, mostly Turkey and the UAE. And to bring that value home without tripping any wires with SWIFT or traditional banks, they converted the proceeds.
Straight into Bitcoin.
Directly. We're talking an estimated $2 billion worth at an average price of around $5,000. That single channel yielded about 400,000 BTC.
That is just an incredible insight into how a sovereign state can weaponize an asset like this.
What about the more recent activity?
That's the second channel, the Petro to USDT to BTC pipeline. This was running from 2023 right up until the operation. After their national petrocoin failed, the state oil company, PDVSA, started settling its crude exports in USDT.
Okay, but why the extra step? Why move from USDT into Bitcoin? Why not just hold the stablecoin?
It's all about censorship risk. Tether, for all its scale and liquidity, is still a centralized entity. The Venezuelan regime knew the U.S. Treasury could, at any moment, force Tether to blacklist and freeze their addresses.
So they had to get it onto the base layer. They had to systematically wash those stablecoin proceeds into the much harder, immutable, censorship-resistant layer Bitcoin for that long-term security.
Which brings us to the market reaction. The brief calls it the Venezuela Premium. You'd think $60 billion suddenly changing hands with the threat of a dump would cause some panic. So why are traders so bullish?
Because the dominant theory on the trading desks is what they call Scenario A, the multi-year freeze.
A freeze.
Exactly. When U.S. authorities seize these private keys, the consensus is that the assets will get moved into U.S. custody and immediately locked up for a very long time.
How long are we talking?
Probably 5 to 10 years, all because of the extraordinarily complex international litigation and asset forfeiture procedures that are required.
So seizure equals lockup. It's basically an involuntary supply shock.
Precisely. This effectively removes 3% of the total circulating supply from the open market. This is structurally different from something like a halving. This is a forced, state-driven reduction in the available float.
Okay, but let me just push back on that for a moment. If the U.S. government is holding 600,000 Bitcoin, isn't there a fear they could use that as a strategic economic weapon later on, maybe to destabilize a hostile economy or something?
That's scenario B, the strategic disposition. And it is discussed, but it's less favored. Analysts believe that liquidating 600,000 BTC, even strategically, would just destabilize the entire global market structure.
Which isn't in their interest right now.
Not at all, especially as they're trying to legitimize the asset through ETFs. For now, the legal complexity just makes scenario A, the long-term freeze, the most probable outcome, and that's securing the current bullish consensus.
So, given that unprecedented political pressure on supply, how did the technicals, the market structure itself, digest this $60 billion headline?
The reaction was swift and it was decisive. Over the last 24 hours of reporting, Bitcoin successfully pierced that crucial $93,000 resistance level. And this was driven almost entirely by the expectation of this supply contraction and just strong spot demand. We saw 24-hour trading volume spike by about 41%.
So it's not a thin move.
No, this is a confirmed thick move. We're consolidating right now just near $92,800.
I remember reading about the clean slate thesis in earlier analyst notes. Can you remind us why fleshing out all that futures leverage is so important for a breakout like this?
The clean slate just means the market structure is fundamentally healthier. Throughout late 2025, we had this massive speculative excess. We estimate about $30 billion in futures leverage had built up.
Right.
When the price started moving, all that leverage was unwound. It was flushed out. And it's vital because a move driven by spot demand with lean positioning is just so much more sustainable than a volatile move built on a house of cards.
And if you're watching the charts, the single biggest signal they're talking about is reclaiming a specific moving average.
Absolutely. Bitcoin has reclaimed the 50-day moving average for the first time since October 2025.
And that's a big deal.
It's critical because automated trading systems, CTAs, they rely on these simple, clear trend indicators like the 50 DMA to flip their bias from bearish or neutral to just outright long. That shift dictates massive institutional capital flow.
So for anyone listening, what are the critical tactical levels they should be watching now that we're in this higher range?
Okay, so on the downside, the real line in the sand for risk management is the hard floor support at $88,500. If we lose that, this breakout thesis is invalidated.
And on the upside?
The primary tactical barrier is that $93,700 to $95,000 zone. That's where we expect the last significant pockets of sell-side pressure to be waiting.
So that's the key to six figures.
It is. Liquidity heat map suggests that if a daily candle can close decisively above $93,700, the sell-side pressure above $95,000 just est, it virtually disappears. Analysts describe it as thin air up there, meaning there's very little resistance to prevent a rapid move toward that psychological $100,000 barrier.
Okay, so we've seen the chaotic end of sovereign adoption in Venezuela. Now let's look at the other side of the coin. The proactive, regulated integration happening in the G7, specifically Japan. Finance Minister Satsuki Kapiyama officially designated 2026 as the digital year.
And this is so much more than just a declaration. It's a strategic mandate. Japan is signaling that they're ready to pivot from being, crypto skeptic to being aggressively competitive. Katayama explicitly backed established stock exchanges like the JPX as the main venues for digital asset integration.
Which means ETFs are on the table.
It means preparation for formal ETF structures is underway, and that opens up an entirely new dimension of capital.
A huge one.
Precisely. It opens up the massive Japanese savings market, which is notoriously conservative and, crucially, large pools of pension capital, all to digital asset exposure through familiar, regulated accounts. Plus, this declaration strongly supports the legislative effort to reduce crypto tax from that punitive 55%.
Yeah, that miscellaneous income classification is brutal.
Down to a flat 20%, aligning it with traditional financial products. That legitimizes the entire asset class, bringing it into the same bucket as stocks and bonds. This is how integration happens by decree.
Now, switching back to the U.S., the Venezuela drama triggered this really interesting regulatory counter-reaction, all driven by a suspicious Maduro insider bet.
Right. It's a fascinating, almost noir detail in this whole affair. Just hours before the U.S. operation captured Maduro, a Polymarket account placed a relatively small but highly precise $32,000 bet on his ouster.
And it paid off.
It netted over $400,000 and immediately raised red flags about a potential leak of classified intelligence.
So someone made almost $500,000 betting on a regime change using classified military intel. I mean, that's either incredible timing or the most expensive regulatory headache in prediction market history. What's the response?
Representative Richie Torres is planning to introduce the Public Integrity in Financial Prediction Markets Act of 2026. It basically seeks to extend the principles of the existing Stock Act, which, prohibits insiders from trading stocks on non-public info, to now include prediction markets.
Now, what's the bigger picture here?
The significant thing is that the U.S. government is regulating prediction markets, not banning them. The need to police insider trading acknowledges their utility and, implicitly, their permanence. They're validating the market even as they crack down on its misuse.
Okay, let's talk about the final gateway to broad corporate America, that service layer. For years, the Big Four accounting firms were the bottleneck, right? Preventing Fortune 500 treasuries from touching digital assets.
But bottleneck is dissolving, and aggressively so. PwC's U.S. CEO, Paul Griggs, publicly announced what he called the firm's strategic lean-in. He cited new legislation like the Genius Act and new stablecoin frameworks as the catalyst for a huge expansion into crypto auditing, tax, and consulting.
Can you just quickly define the Genius Act in this context? What's the key takeaway?
The key aspect for a firm like PwC is that it provides clearer statutory guidance, especially on how you classify and handle stablecoin reserves and digital assets. This clarity lets top-tier auditors finally sign off on corporate balance sheets that hold crypto. It effectively de-risks the whole asset class for the Fortune 500 by finally addressing that historical audit gap.
And with that audit gap closing, we're seeing this amazing evidence of utility, of real-world spending, moving beyond just treasury holding.
Absolutely. The new data shows that total net spending on Visa's crypto-linked payment cards surged by a staggering 525% in 2025.
525%.
It rose to $91.3 million by December. And interestingly, EtherFi, a liquid staking protocol, actually led the pack with over $55 million in spending.
That data really validates the transition from a pure store of value to a reliable medium of exchange, at least through these hybrid fiat crypto bridges. But it's not a smooth transition everywhere, is it? We're seeing that in Argentina.
That's the operational friction we have to acknowledge. Coinbase's retreat from Argentina is a crucial lesson. They just announced they're suspending peso to USDC trading and local bank withdrawals.
Which isn't just about Argentina. This is a clear warning sign for anyone using centralized on-ramps in capital-controlled jurisdictions.
It is. While crypto-to-crypto trading is still there, removing those fiat rails disrupts the main dollarization trade for locals who relied on Coinbase. It just highlights that even these big international platforms have to pull back the instant regulatory complexity or currency volatility spikes. Centralized access points are still vulnerable to state control. And as we discuss this new era of sort of sovereign hardening, it's critical to check in on the risks. Because while the core Bitcoin protocol is secure, the periphery, the vendors, the user interfaces, it's still fragile. We saw this vividly with the vendor risk from Ledger. The data breach involved their third-party payment processor, Global. It exposed customer names, contact details, order information.
And while the private keys were safe, that data is highly, highly sensitive for people who self-custody.
It is. This significantly increases the risk of targeted phishing and, more chillingly, what are called wrench attacks, actual physical violence against high net worth holders. It reminds us all that protecting your personal data is just as important as protecting your keys.
And then there's the governance risk in DeFi, which is still just a massive target.
You just have to look at the $3.9 million hack of Unleash protocol. The attackers didn't exploit a flaw in the code. They got control of the multi-sig governance wallet and used that admin access to push a malicious contract upgrade.
So it's a centralization problem.
Exactly. It underscores that centralization vector vulnerability in so many of these DeFi governance models. If your admin keys aren't decentralized or time-locked, the protocol is basically a custodial target.
But despite those risks on the perimeter, the foundational strength, the base layer of Bitcoin core development, seems to be reversing a multi-year decline.
That really is the ultimate silver lining here, and it's the defense against these outer vulnerabilities. Development activity on Bitcoin Core surged in 2025. We saw mailing list traffic increase by 60%, and the number of unique code contributors rose to 135.
So serious talent is coming back.
Serious technical talent is returning to the base layer, and they're building critical infrastructure, things like Covenants and Stratum v2.
Which are huge for security and decentralization.
Exactly. Covenants are fundamental for building more secure Bitcoin vaults. Stratum v2 is all about mining decentralization, making sure pool operators can't unilaterally censor transactions. This base layer focus reinforces the core asset's strength. So, to synthesize this incredible briefing, the market is presenting this kind of Janus face. On one side, you have sovereign hardening, the Venezuela seizure, the Japan pivot, the PwC integration. But on the other face, you have this persistent operational fragility, the ledger breach, the Coinbase friction in Argentina.
But that structural removal of 600,000 BTC from circulation, that is undeniably the dominant narrative right now. It seems to be outweighing the short-term fears. The immediate bullish bias, though, it all hinges on clearing that resistance level of $93,700. So what does this all mean for you?
We are seeing governments, both hostile and friendly, actively acknowledge Bitcoin's power. They're either strategically legitimizing it, like Japan, or they're acquiring it by force, like the U.S. operation in Venezuela is setting up. And this raises a really important question. If Bitcoin is transitioning from a censorship-resistant tool for the people to a strategic national security asset for states, what fundamental role does decentralization play in the next decade of its evolution? As we navigate this new era, understanding the difference between secure self-custody, which is supported by the strength of Bitcoin Core, and that vulnerable centralized periphery becomes more critical than ever before.